Hey guys, Brian's here. Today's Tuesday, December 3rd, 2024. Let's go over a step-by-step guide on how I approach trading calendar spreads. A calendar spread falls under the family of horizontal spreads because it is constructed by trading multiple strike prices across two expirations, in contrast to a vertical, which is what many beginner spreads traders are familiar with. A vertical is dealing with multiple strike prices across a single expiration, so you're dealing vertically within the options chain. A calendar can confuse beginner traders because now you're dealing with strikes horizontally across multiple expirations. This particular example that we will be going over in this video is actually a calendar spread that I opened yesterday. It is the 6035 call calendar on the SPX. My front month is December 20th and my back month is December 27th. Front month and back month are old terms left over from when calendar spreads were traded using just the monthly expirations. For simplicity of this video, I'm going to refer my front month as my short strike or my short expiration, and then my back month will be referred to as my long strike or my long expiration. The reason I'm calling it that is because this call right here was actually sold to open, and this call right here was actually bought to open. In other words, I am short this call and I am long this call. That is actually what makes up a calendar spread. When you submit the order, it is sent out simultaneously. This is the same calendar spread in my live risk profile on Thinkorswim, which is my brokerage of choice. This is it right here, the 6035 call, the 6035 call for December 20th expiration and the December 27th expiration. I am in 4 lots, so I have 4 of each of these calls. This is the current P&L right now as the market is currently open. This is the theoretical P&L if the market was to go down 1%. This is how much 4 lots of this calendar would be down. And if the market was to go up 1%, this is the theoretical risk profile. The reason this is theoretical, and this is important to understand when using a risk profile with calendar spreads, is because no one knows how volatility will interact as time passes on, as well as price moves. As we can see right here, there is no volatility adjustments. But let's just say the market was to stay exactly where it is, but the implied volatility for the December 20th expiration was to increase. That would actually have a negative impact on this calendar. Now, this is highly unlikely to happen, that the market will just stay in place and implied volatility would increase for one expiration without increasing for the other one. But these theoretical fluctuations in implied volatility is what makes calendar spreads sometimes hard to understand exactly what's going to happen. So that's why it's important to understand whenever you are mocking up a calendar spread in your risk profile, to understand that all of this is theoretical because of implied volatility. Now, if time was to pass by, let's just say we jump forward 7 days from now and we jump to next week, December 10th right here, we can see that my theoretical risk profile will be up over $1,000 on 4 lots. If the market went up 1%, it's saying that theoretically I'll be up about $850. And if the market was to go down 1%, I'll be up theoretically $383. But if the market was to drop 1%, let's just say that happened rapidly and there was some crazy catalyst that came out around December 20th, that can cause this implied volatility to maybe spike up 1%. So even if the market was to drop 1%, that is generally going to be good for a calendar spread because it will have an increase in implied volatility. If that increase in implied volatility, in this case here, 1%, only affects the expiration in which I am short, that is not good. The reason that's happening is because the implied volatility for this expiration, December 20th, would be increasing the price of the 6035 call that I'm currently short. That is not something I want to happen. The short strike or the front month is the expiration that you want a decrease in that price, because that is actually how you profit with the calendar spread, in combination with your long strike holding its value or increasing in its value. So in other words, if the implied volatility also increased for this expiration, now you guys can see this would be a healthy risk profile here, as the implied volatility increased by 1% for both expirations, as the market either dropped 1% or it went up 1% over the next 7 days. If the implied volatility was to decrease for our front month while the back month increased at a higher rate than the front month, then you guys can see that can do wonders for a risk profile. However, that scenario is highly unlikely. Let's reset the volatility, put it back to normal, and then let's also reset to today. So this is the current risk profile right here. The green line is referred to as the T+0 line. That is my current P&L. And then this white line is the P&L at expiration, or the theoretical P&L at expiration. These lines right here are the break-evens for this calendar spread at expiration. But as we just covered, implied volatility affects all of this. So if the implied volatility was to increase for this one, you guys can see that the break-even is being pushed further and further out at expiration, and then significantly affecting the T+0 line, which is great. Understanding the impact of implied volatility is important when selecting your expirations, because there is something called volatility skew, which we will get into in a few minutes. OptionStrat is a website that I highly recommend. I've been using it for years, and it's a great place to learn to trade spreads, as the UI is beginner friendly. And for those of you that don't have thinkorswim or don't use a risk profile as advanced as thinkorswim, OptionStrat is universal regardless of what your broker or your platform is. This type of calendar spread can fall under the realm of an income spread, because I pretty much went at the money when I opened the trade. In other words, the SPX is at 60.40 right now. This calendar was created using the 60.35, so it's within a 5 to 10 points, radius of the SPX. So it's relatively at the money. That means I'm not picking a direction on which way I think the market is going to go. I'm looking to benefit from the passage of time, from being positive theta, and also some sort of an increase in implied volatility. The calendar spread is positive vega and positive theta. In other words, I'm long vega and long theta. When opening at the money calendar spreads, you want a low delta. Let's just say we were going with an out the money calendar spread. It can look something like this. This is saying, hey, I think the market is going to go up to 6,100. So I'm selecting a calendar spread like this. You guys can see that the delta has increased significantly. A trade like this is not an income spread, as you are picking a direction. If the market was to go down, this spread would start losing money aggressively, as we can see right here. That's demonstrated on this risk profile. Let's reset this for a second here and just take a look at the calendar spread that I currently have open here today. The reason I'm demonstrating all of these scenarios is because no two calendar spreads are exactly the same. You can trade them out the money to the upside. You can trade them out the money to the downside. You can trade them at the money. You can use calls. You can use puts. You can use two expirations that are further away from each other. You can use two expirations that are right next to each other. There's close to an infinite amount of possibilities for how you construct these calendar spreads. The main one we are addressing today is an at the money calendar spread with at least 1 week between the expirations. So it has a 7-day term structure. Now, why would a trader open a calendar spread now? The first thing to take note of is implied volatility. It is positive vega, which means it benefits from an increase of implied volatility. This is the VIX right now for the markets. This is the daily chart. And we can see that over the past couple weeks, implied volatility has decreased significantly. Now, it can decrease and stay in this low area below 14 for weeks and possibly even months, which is also not good for a calendar spread, as you don't want implied volatility to keep decreasing as you open the calendar. That's why opening it when the VIX is already relatively low can be a bonus. However, you can trade calendar spreads when the VIX is also high. But whenever the VIX is below 15, I tend to favor calendar spreads, as the implication or the expectation is that the VIX won't go much lower or it will increase. The reason we monitor the VIX is because it is a good gauge on the overall implied volatility for the S&P 500. When you are selecting your expirations for calendar spreads, you want to monitor your volatility skew. This is the December 20th expiration, and this is the December 27th expiration. So as you guys can see, this is the expiration I'm short. This is the expiration I am long. It is the same 60.35 call here, the same 65.30 call here. This is the implied volatility for this expiration, and this is the implied volatility for this expiration. The thing to take note is this expiration has an implied volatility theoretically of 13.64, while this expiration has a implied volatility of 13.27. This implied volatility is less than this implied volatility. That is called a volatility skew, and that is something you generally look for when trading an at the money calendar spread. That skew is an edge that can be exploited. It means there is inherently a premium that is baked into this expiration. This 60-35 call, one can say, is a little bit more expensive than this call. This call is currently at 24 DTE, so it has 7 more days till expiration than the call for December 20th. However, this call is more expensive. That's why we are selling or shorting the call that is more expensive, because we want to collect more premium. That is generally going to be step 2 for myself. If step 1 is first and foremost paying attention to where is the VIX and deciding if I want to go at the money, out the money, up, or out the money, down, we can label that as step 1. Step 2 is trying to find expirations that have a decent volatility skew. I like to keep at least a 7-day term structure between my expirations. So in this case here, December 20th as the front month and December 27th as the back month. That is a 7-day separation between these expirations. Whenever I'm going with income spreads or at the money calendar spreads, that is my preferred distance between the two. I generally also like to keep them to the same day of the week. December 20th is a Friday, and December 27th is also a Friday. And my notes at the top here, whenever you save a trade in OptionStrat, you can type in a description and you can leave notes for yourself. I will generally continue to update the description as time passes by. So for example, tomorrow, if there's any major changes in implied volatility, I will take note of that. This term right here is saying this is a Friday to Friday. I like to mark where the SPX was when I opened the trade. As you guys can see here, I was about 9 points out the money to the downside when I first opened the trade. As I went with 35, the SPX was at 44. This is what Thinkorswim was saying was the implied volatility for the front month, and this is what Thinkorswim was saying was the implied volatility for the back month. So 1395. As we can see right now, it's 1359. So the implied volatility for December 20th has decreased slightly. For our back month, it's currently around 1316. When I opened the trade, it was 1350. So implied volatility overall has decreased, we'll say 0.30, 0.40% or so. It's fluctuating again because the market is currently open and volatility is constantly in flux. But it's important to at least understand when you first open the trade, there is a volatility skew here. As we can see, there's a difference about 0.45% of a difference in implied volatility between these two expirations. That essentially is my volatility skew. The next step is being aware of the calendar. This is our front month of December 20th, and this is our back month of December 27th, so a Friday to Friday. You want to then check out the economic calendar to see what catalysts are there on the horizon, and why is there a higher IV for this expiration. It's likely due to there being something on the economic calendar for this week. I use Forex Factory whenever I'm checking out the economic calendar. You can just jump ahead and click the week. So this is the week we are inquiring about. This is December 20th. This is the economic calendar for the US for that week. And as we can already see right here, on Wednesday at 2 p.m. is our next FOMC announcement. We also have the core PCI numbers. We have some unemployment numbers. We have final GDP. We have some retail numbers. And we have the manufacturing PMI numbers. So a lot of catalysts for this week. That is going to explain why the implied volatility for this expiration is higher than the implied volatility for this expiration. If you ever discover a week in which the implied volatility is much higher than the implied volatility for the week out, and there's no catalyst on the horizon, that is a major edge. It's rare to spot that, but if you do, the calendar spread is almost always going to guarantee some sort of profit. If you're going at the money at least 5 to 10%, it's generally going to be a guarantee, because that inflated IV is generally just going to drop within a day or two, and you can usually hit about an 8% return within 48 hours on an at the money calendar spread that is at least 11 to 15 DTE in expiration. In my case here, when I opened the trade, this was an 18 DTE. But anything around this window of a 14 to 20 DTE or so for your short strike, if you spot that volatility skew, it generally leads to a great trade. A warning with this type of catalyst on the horizon can mean that the December 20th expiration IV can keep increasing as we get closer and closer to December 18th. And as we covered at the start of this video, that is not a good thing. That was the example right here of December 20th. If the implied volatility keeps increasing, that's not going to help this calendar spread. However, if we jump forward in time, if this implied volatility was to increase 1%, This would need to increase at least 0.5% for this calendar spread to yield some sort of decent return. Because these expirations are 7 days apart, if the implied volatility was to increase for this expiration, it's more than likely the scenario that the implied volatility will also increase for this expiration. If when you first open your calendar spread, you're going with a 30 DTE for your short strike, and then you're going with a 60 DTE for your long strike, that is an entirely different beast, as the time decay on your 30 DTE expiration should offset the unpredictable nature of implied volatility, but that is entirely a different type of beast or a different type of income spread. This type of calendar spread is one that is less than 30 DTE. As we can see right here, it's 17 DTE. When I open it, it was 18 DTE. For example, let's just say we were to open up another calendar spread right now. And let's move forward here. And let's just say we were to go with a 30 DTE right about here. This is a Friday, so this is January 3rd. Let's take a look at our calendar. This is January 3rd right here. Let's just say we were to jump to the first Friday of February. That would be February 7th, which is not currently available. But this is close to about 30 days apart. This is also about a 30 DTE calendar spread. This is a different beast in contrast to the calendar spread that we are analyzing here today, where the short strike is under 30 DTE. Time decay is harsh when it's less than 30 DTE, and once it enters that 15 DTE window, time decay starts really eating away at options. Whereas the long strike in this case will be outside of that 15 DTE windows, so it should hold some of its value better than the short strike in this case here. Again, there are so many different ways to trade and construct your calendar spreads. I'm just trying to expose you guys to some of the thoughts that you should be having when you're opening them. Like anything, the only way you can get good at them is by practicing, either by paper trading, taking notes, and saving them on a platform like OptionStrat. Even if you don't take the trade live, I recommend journaling it and paper trading it for a few months to at least see how they work. And even though I've been trading calendar spreads for years, as some of you might have seen on this YouTube channel years ago, they were my favorite spreads to trade over verticals when I first started out trading spreads, as I just had an affinity for them. Even to this day, I will still journal alternative spreads to see which one has performed better. In this case here, if we just check out some other saved trades, this is one that I have that is not live as it is an alternative. The reason this one is an alternative is because I wanted to see how will one perform better if I went with the Friday and the Friday, which is the one I decided to run live, versus the Monday to Monday expiration, because I'm not sure if the FOMC announcement is going to significantly negatively affect this particular expiration. I wanted to see how will one perform using the Monday to Monday expiration. So the next time I will have in my notes, hey, out of the last 10 occurrences that you ran these calendar spreads, you've noticed 6 out of the 10 times it was actually better to use the Monday expiration over the Friday. The only way I'll know that is by journaling it, or of course backtesting the last X amount of FOMC announcements. But I like to run both scenarios in real time to also see how they operate on a day-by-day basis in real time. I also marked what the implied volatility was, so it had relatively the same skew, about a 0.45% difference between the expirations. I'm able to mark that both of them were about the same price. Now I'm just sitting back to see, even after I take profits on this spread, I will continue to leave them on OptionStrat until expiration just to get a gauge. And as I said before, I will continue to leave notes. So in other words, if I was to leave a note right now, I'll just mark that this is currently Tuesday. The P&L is it's currently up $5, or in this case here, it's up about 1%. And then we'll mark that the spot price for the SPX right now is 60.36. And so forth. I'll also mark what the IV is just to keep track of what was it like throughout the duration of the trade. However, since I just opened it yesterday and there hasn't been much changes, I'm not going to clutter up the description with unnecessary notes. That's what some of you guys may be familiar with in quant trading app. Over the past few years, as you guys know, when I will share any of my notes here, you guys can see, for example, here, it was opened on Wednesday. Here's Friday, and then here's the following week, Tuesday. This is the P&L of the duration of while I was holding the trade. In this case here, we can see in the morning, the trade was up about 3. And then later in the afternoon, so a couple hours later, the trade was up almost 6%. And this is when I was closing it. Keeping these types of notes, regardless of what type of spread you run, is important for learning and understanding the changes. And this is actually how you get good. You do this for a couple years. You'll reinforce your understanding. You'll have a better gauge on what's likely to happen with your calendar spread. Regarding profit targets for an at-the-money calendar spread such as this, My first take profit is usually going to be around 6 to 8%. It used to be 10%, but because that became harder to hit consistently, I started lowering my first take profits. 5% is generally going to be a decent profit target. 7% is ideally what I try to aim for, so 7 to 8%. In this case here, if I'm in multiple lots, I'll try to hold a runner. Regarding adjustments, that's something for another video. But to summarize it, if the market was to get close to breach the perimeter of this tent, I will open up another one, creating a double calendar. In other words, if the market was to go up about 1% in this case here, I'll more than likely look to open up another calendar spread. Same thing if the market was to drop in this case here about 0.75% or so, the spread would be at risk. And the way you defend these is you just open up another tent and you extend your profitability zone. But obviously, as you turn it into a double calendar, you're adding more risk by using more margin, more capital. So you always want to make sure you have enough cash on the side. In my case here, I only went with 4 lots because I'm prepared to add another 4 lots if needed to turn it into a double calendar. The amount of margin being used for myself is right here, so about 4 grand. I like to usually put aside at least 10K for calendar spreads for this particular margin portfolio. If 10K is how much margin I budget for this particular strategy, that means I can only run up to 4 to 5 lots because I need to make sure there is enough margin on the side to defend or make any type of adjustments. When calendars were a little bit more consistent, 20K was the budget that was put aside for this particular strategy, but it changes with the time, it changes with the season, it changes with my portfolio, and like any trader, it should also change with what's happening outside of the market. Hopefully this video cleared up some confusion regarding the calendar spread strategy. I think it is a great strategy for any trader to have in their toolkits. You can build a portfolio around calendar spreads. So in other words, this SPX calendar spread that I currently have, I will then add some sort of iron butterfly. I will probably add a 45 DTE iron condor. I'll mix in some weekly options, maybe with a broken wing butterfly. And before you know it, there's about 4 to 5 different strategies simultaneously being run on the SPX. These are all trades that benefit from the passage of time. So as long as the market doesn't make any outsized erratic move in a short period of time, all these different strategies will benefit. As you guys can even see right here on my live risk profile, on this Thinkorswim accounts, if I were to open up some other strategies, you guys can see I'm also in a double calendar spread, which is currently down right now, but this spread expires next week, Friday. Again, this is a completely different strategy, but I'm layering a double calendar spread with a calendar spread for a couple weeks out. This one is within the 2-week window. Next, I'm going to look to add some short Vega trades like an iron condor or an iron butterfly just to reduce my Vega exposure a little bit. Or when you're reading your risk profile, these are the things that you want to have some sort of an understanding. It starts by first using one strategy. In this case here, pick a calendar spread, pick an iron condor, pick an iron butterfly, whatever you have an affinity for. Run that particular strategy for 2 to 3 months. Get familiar with it before you start layering multiple strategies in one portfolio at the same time. Guys, if you enjoyed this video, like it, leave a comment down below, subscribe to the YouTube channel, and I'll catch you in the next one. Thanks for watching.